Hello guys, welcome to the DMS FX. If you're new to this channel, please, you are most welcome. So on this channel, I will be teaching Forex trading. All right, and thank you so much to those of you who have started subscribing to this new channel from my previous YouTube channel, which is about education. And please remember, when you come and watch the video here, remember to subscribe, like the video, comment, and also share, so that you send a very good signal to the YouTube algorithm about the video. Because liking the video, sharing the video, commenting and subscribing to the video sends a very good signal to the YouTube algorithm about how the video is. When you like, you share, you subscribe, you comment, it sends a good signal that the video is informative, educative, and good. And therefore, the YouTube algorithm also starts suggesting it to other people. But when you just watch without liking and sharing, then the YouTube algorithm is going to consider the video as bad, and it is not even going to suggest it to other people, and therefore our YouTube channel is not going to grow. As much as you have subscribed to this YouTube channel, when you see the video pops out from this YouTube channel, remember to like, comment, and share, because I believe you also want to see this YouTube channel grow. Who would want to be on a channel which just have 5 subscribers for many months? No one. So remember to help the growth of this YouTube channel by liking, commenting, subscribing, sharing. All right, so even new viewers, as you are watching my video now, please remember to like, comment, subscribe, and share, and I will really appreciate for that, so that our channel can grow. So because our channel is about forex trading, and if you are new to forex trading, like some of you that are coming from my other channel, I believe you are newcomer to the forex trading industry, or newbies to the forex trading industry, and therefore the videos that I'm uploading on this channel will give you the basic understanding of forex trading, so that it will make your beginning of forex trading journey to be very smooth without many hardships. All right, so today's video is titled the architecture of market structure. In other words, today's video is going to talk about the architecture of market movement. In other words, it is going to explain to you why the market moves in this way it moves. That's why this video is very important, and then you need to watch it from the beginning to the end without missing anything, so that you will be able to understand the architecture of market structure. Because when you understand the architecture of market structure, it will be able to help you to predict the direction in which the market moves. Remember, in our previous video we talked about retail traders as trading forex in a form of what we call the CFDs, which is a contract for differences, meaning that as retail traders, when we come to the chart and place a buy, it means that we are predicting that the market is going to move in the upward direction, and therefore when we place that buy, what happens is that we are going to be paid on the difference between the entry and the exit, especially if we bought and then the market went in our direction, then we exited, then the broker is going to pay us based on the difference between the entry and the exit point. Now, for us to be able to determine the direction of the market, I told you that we have to do what we call technical analysis. All right, now technical analysis cannot only be done because you have seen that the market is moving like this, therefore if it is here, then you know that the next move it will go up. No, it's not like that. There are other underlying factors which makes the market to move the way it moves. And this video is going to help you understand why the market moves like this. And when it makes you understand why the market moves like this, then it will be very easy for you to analyze the chart and then predict where the direction of the market is going to go. So to help us see, that's why I've prepared this presentation here to help us understand the movement of the market, and that's why the title of this video is known as the architecture of market movement. So the architecture of market movement presentation will help us see understanding market psychology and the structural cycles in forex and financial markets. So it will help you to understand the cycles that are in the market. So it will help you also to understand why prices in the market always rise, they crash, and then rise again. Okay? A breakdown of 6 key phases is going to be presented to you, which is going to help you understand the key phases that the market goes through to create this kind of movement that we see here. All right, so let's go straight into the presentation. All right, so here we are. Let's look at what happens. The repeating market cycle. So the repeating market cycle are driven by human behavior and the money flow. So these market movement like this, they are driven by human behavior and money flow. It is human behavior which makes the market to move the way it moves like this. So understand that the market moves in the way it moves in its cycles due to, number one, human behavior, then number two, money flow. All right? All right. So let's look at the core principle. Market movement is not random. Okay? So you need to understand that market movement, the movement of the market, the way market moves, it is not a random thing. It is a predictable sequence of structural phases driven by the prevailing emotions of investors, which is fear and greed. So the way market moves in a predictable sequence. Okay, and this movement that the market shows is driven by emotions of investors. So emotions of investors are what drive the market. Which emotion are these? We have emotions of fear, and then we have emotion of greed. So understanding these emotions, where they appear, at which stage of the market fear comes in, at this stage of the market greed comes in to come up with this movement like this, then you will be able to know, oh, at this point investors have got a greed, at this point investors have got a fear, and therefore you will know the next move which the investors will do. And once you know the next move which investors will do, then you will be able to predict the direction of the market. So always when you come to the market, the goal is to identify which phase the market is in to anticipate the next structural move. So when you come to the market here, you must be able to know what the phase in which the market is in, so that you do what? You can anticipate the next structural move. Okay, so it is very, very, very important that you understand this. So what are the 6 phases of the market cycle? So the 6 phases of the market cycle are, number one, there is what is known as accumulation. What happens in accumulation? Smart money buying, or rather investors that are known as smart money buying, they begin buying. Then the next phase is markup. We are going to understand this in details. Markup where the bull run begins, like the market begin moving. Like in the chart here, this phase can be referred to as the accumulation, especially this phase here. Then this phase here can be referred to as the what we call a markup or a bull run. Okay, so now we have also euphoria, the peak hype or the excitement stage. So the market reaches also the excitement stage. So you have to come to the market and be able to know, oh, at this point the market is now at the excitement stage. Okay, then also we have what we call distribution. So the euphoria stage, which is the excitement, this is the peak hype, where everyone is hyped, is aware about the market. The market, if it is in the bullish, everyone is aware now. Everyone wants to buy. You have to identify. When that happens, what happens next? There's a distribution. Distribution now, smart money selling. So the smart money guys begin now selling. Okay, like you see here, the moment there's this one here, then the smart money were the ones selling here. They sold a little bit, then there is another high peak here, then they sell a little bit until whatever they did here finishes. That's what they do. So you will understand in details. Then there's what we call capitulation, where the market crash due to fear. Then also there's now re-accumulation, where the cycle starts again. So it's very, very important, guys, to understand this. And guys, if this information that I'm giving you out now is already beginning to open you up, please remember to give the video a like. Remember to subscribe, comment in the comment section, and please share so that I may also be encouraged. All right, so let's continue. So now, let's go in detail about phase 1, which is the accumulation. Accumulation is what we can refer to as planting the seeds. Like a farmer goes to the field and begin planting the seed. Now, what happens under accumulation? Let's begin with timing. So timing, or this one happens or occurs immediately after a crash or prolonged bear market. So the timing of the accumulation is that the accumulation occurs immediately after a crash or prolonged bear market. So this accumulation, when the market is in the bearish, it is going down for a longer period. The moment this one begins going, as it is dying, then accumulation begins there. Okay, so you should anticipate that as the market begins now undergoing what is known as a crash, then accumulation begins. Okay, so that's the timing you need to know. So what happens here in terms of price action? Prices are low. At this point, prices are low. Okay, often moving sideways in a tight range. Like here, prices are very low and moving in sideways. They are not moving up, they are not moving down, but almost in sideways, which is known as a range. So what are we saying? If it is like this, the market went like up, then it starts crashing. Then after it crashes, it starts moving in a range like that. So this is what we mean. So here, this stage is now what is known as the accumulation. Okay, so very important they understand. Oh, you have reached now accumulation. Okay, so in a tight range. Then what else happens? Public sentiment. Like, what do we mean? Most traders are fearful or bored. So here, at this stage of accumulation, Most traders are fearful or bored, scared to buy back in the market. So at this point, the traders are fearful, they are bored, and then they cannot be willing to buy the market because they have been experiencing the bullish market. So they are fearful of buying again because they experienced a loss here. So now, this point now, smart money is accumulating. Okay? So now, what also happens here is that smart money action. So here, institutional investors and experienced traders quietly start buying large portions, believing the worst is over. So for them, they are the one who moves the market. So what will they do? They start what? They start buying large portions quietly. Okay, so in this stage, they are buying. This is stage which is here. They are buying portions quietly because for them now, they know that the worst is over. Once the market reaches here, the worst is over. They begin buying quietly. All right? So what also happens here? Trader insights. This is the best time for long-term entry. So trader insight, like you and me. Now, what are we supposed to learn from here? We should now learn that this is the best time for long-term entry. If we want to enter so that we can stay for a longer time in the buy position, this is the very time we are supposed to enter as well. You have seen. So this is the best time for long-term entry. Buying before the masses notice. So before the mass notice to say the price now is going up, you need to be already starting to buy. Now, if you have less capital, this is not a very good point to begin. This is very, very good, especially for those with bigger capital, where they begin buying smaller position with risky management attached to it. Okay? So that before the public notices, because here everyone will notice that the market is buying and they begin entering, and it is dangerous. You begin somewhere here. All right? So let's move. Now we go to phase 2 and 3, which is mark up to Euphoria. So this is the start of Euphoria. So we are saying the bull run and the hype trap. So this is the cycle we are talking about, this point especially here. So we are saying phase 2, which is markup or expansion. So what are the action? Prices begin to steady, sustained upward trend as the momentum builds. So there will be steady increase. The increase will be steady but bit. Okay? So there will be momentum building. There will be like momentum, which is like there will be a force pushing the price to go up slowly by slowly. Okay? So liquidity. So here there's liquidity. Demand starts overpowering supply. So at this moment, there will be more demand than the supply. Demand is up, supply is down. Okay? Then sentiment. Sentiment, like what will be happening now within the forex market in terms of information. There will be confidence. Confidence returns. When people see the small rising, they say, oh, so the market is going to rise. The confidence begins to say, the market will now start. Media highlights the recovery. The media starts talking about now, oh, we see the movement now, oh, it's like there's a recovery. So the media will begin talking about it. Then retail entry. So ordinary traders begin to join, accelerating the trend. So those early retail traders will begin now entering as they see this movement. As they enter, the movement now will be accelerated. You see? So After the markup, which is expansion, we go to the next stage now, phase 3, which is euphoria, the peak. At the peak now, here now, everyone has entered, therefore, accelerated, like they've catalyzed the market. Now the market begin going up now, okay? So action, prices shoot up rapidly, often vertically, like you can see here. Price will begin shooting up vertically, okay? So sentiment now, what will be the information around now in the forex industry? Extreme excitement. Forex traders will be happy. Now we are back in the bullish market. Belief that prices will never fall. So this time around now, price is going up. It will not fall. Okay? So there's overconfidence now. Everyone now is aware of it. They are entering now. So price begin rising extremely high. Okay? So then comes the trap. Okay? So new traders rush due to fear of missing out, FOMO, fear of missing out. So this is the most dangerous stage. So at this point, especially this one here, where the price goes vertical up, traders now, when they see like this, they say, oh, price now is going up. We are going to miss out in this move. Let's join. They begin joining. Okay? So this is the most dangerous stage as early investors start exiting. The moment this movement comes like that, those that entered here, it is the time they begin exiting. That's why you see these ones are moving down. So they exit, those who are hyping comes in, they exit, those who are hyping comes in, they exit, those who are hyping comes in. So some of them that entered here, they have exited already their position, they're in profit. Then those that maybe entered here, they're not yet. Then those that are still coming to hype the price will continue going. Then those who entered later here, they also begin doing what? They begin exiting. You have seen. So that's what makes the market to move. Now, as you are now trying to understand the market, the way it moves, it is going to help you very much, and it will give you good risk management, because when you are entering into trading, you must know at which stage of the market are you, so that you become very, very cautious about the market. You become you take what we call risk management steps. All right, so let's see what happens to the next stage, phase 4 and 5, distribution and what we are calling capitulation. So here the silent sell off and the panic starts. So there will be selling off and then the panic starts. So phase 4, distribution, which is selling. So here the action, price stores. So at this point, your distribution, price stores, almost the price remains at the same. Price does not move now. Price will appear to stay at the same position for a longer period of time. Like, let me expand here. So you see here, the price went, the smart money were selling, went. So price now begin moving in the sideways. That hype now is over. The guys that entered here, they exiting. Okay, so this is Bitcoin actually. So the price now is exiting up to that point. So those who entered, they've already made their profit. All right. So smart money quietly sell positions to the late arriving euphoria buyers. So these guys, when they are selling at this point where they are selling to those that joined due to excitement somewhere here. Those who joined now, these guys, as they're selling to these guys. Okay, they are selling to those guys, they are selling to those guys. Okay, that joined the market very, very late. Okay, so signal, the market looks strong, but the upward momentum is dying. So like here, the market may still be looking strong. People, they say, but you see, the market is still there. This is still the bullish trend coming in. So people are in doubt. Like here, as it is like with the Bitcoin, people are in doubt. Some are saying the Bitcoin is still buying. Some are saying the Bitcoin is selling. So people here, they're in total confusion. Okay. Then comes the phase 5, which is known as the capitulation, the crash. So action, price falls sharply, often triggered by bad news or broken support levels. So price can fall sharply, like here. Like here, you see, here price had to fall sharply. There was news actually here where I think Trump talked about increasing tariff for China products in USA, something like that. Then there was a crash in the market at this point for many commodities and the indices. Like when we look at gold, there was a crash here. Okay, when we look at the Nasdaq, there was a crash here. Okay, so there was a crash there. So there will be a crash under capitulation. All right, so it may be triggered by news, bad news, or broken support levels. Like there will be certain support levels that are broken. Okay, maybe there is a support level like this one here. Its support level can be considered to be a support region here, where the price came here, bounced here, came, tried to go down a bit, it failed, it came back, it bounced, it came back, it bounced. So when price like comes on this one here, the other time it comes, it breaks down, it comes here. Then what happens now? Price will continue falling sharply. So sentiment. Now, what will be the news now in the forex industry? Total surrender. Let buyers panic and close the trades at the maximum loss. So most of them here, they'll be incurring losses at these stages here. Okay, traders will be incurring losses at these. Those with huge amount of money who joined late with a lot large stop losses, they will say, the market is just going down. No. We are going to lose our capital. Let's exit the position. The position they will exit. Some stop losses are done what are hit and they exit the market. All right. So here traders are in confusion, they're in panic. That's why we are saying total surrender, let buyers panic and close the trades at maximum loss. Then what else in terms of liquidity? Massive outflow of money, creating a low price floor for the next cycle. So there will be what? There will be massive outflow of money. So money will come out of the market at this stage, because when there's bad news, also those that entered early, they are coming out because of that bad news. Okay, and also those that are afraid of losing, they're coming out. So money is flowing out of the market. So the price now goes down in preparation for the next phase. Okay, so that's why the massive outflow of money are creating a low price flow for the next cycle. Okay, then comes the phase 6 again, reaccumulation. So here the cycle resets, it starts again. So the perpetual loop, meaning the continuous loop. After the crash, which is the capitulation, price stabilize and stop falling. Like in this case, we can say maybe it is this point we are in. So price will stop falling. Now it is going back a little bit. So this one might again fall. We don't know, but it looks like it can fall. It can as well fall a little bit there, and it begin like from what we are learning behavioral. This can a bit come here, fall somewhere there, and a little bit, and begin going sideways, again begin building. Now, because the world economy has grown, is growing very fast because of artificial intelligence, usually these recoveries are happening very fast. But a long time, these would take time. But these days, it seems like they're happening very fast. It can just happen in a week, then there will be a cycle. So understanding this very cycle, it is going to put you at an advantage with other traders who do not have this information. So here we are saying experienced investors once again recognize that prices are undervalued, meaning that prices are at low price for them to begin buying. Okay, so they initiate quietly buying, completing the cycle and starting the next accumulation. So this cycle repeats across all financial markets and the time frames forever. So the cycles, they repeat, and understanding them that they repeat, it is upon you and me now to be able to be intelligently listening to the news as well, so that we can know where we are in terms of the market movement. When we hear too much hype, we know, oh, we have reached at this stage. The hype is connected with maybe movement of the market up. Then we know, oh, the smart money now will be exiting their position. So we should be careful in seeing the signal that is about selling. So here you have to be careful. Like here, when you are somewhere here, you reach at this support here, you have to look for signals about selling. You have to be careful. You look for signals about the selling, which I'm going to also teach in my next video, because my next video will be able to give you, when you understand the market structure, how are you supposed to now begin entering the market? What signal can you see to enable you enter short positions? Because you and me as retail traders, we don't move the market. Therefore, we predict the direction of the market so that we can take opportunities in smaller price movement. We chance the movement, we sell quickly. So like what technical analysis now can we do to realize now the market here is selling? We participate in the selling move. Like in this selling move, can we participate in it? In this selling move, can we participate in it? In this selling move, can we participate in it? So that is what the next video is going to talk about, because the market repeats forever. Okay, now let's talk about the three forces behind the cycle. What makes the market move? One, liquidity flow. Okay, so the total capital entering or leaving the market. So liquidity flow is the total capital entering or leaving the market. More money in, meaning buying, causes prices to rise. Money leaving, meaning selling, causes prices to fall. Then what else? 2, investor psychology. The core human emotions of greed pushing markets up and fear dragging markets down create wave-like structure. So these wave-like structures here are created by greed. I want to make more money, let me enter. Or fear, I might lose money, let me leave. So those are created like that, those waves. So what we are talking about, investor psychology, you understand. The core human emotions of greed pushing markets up and fear dragging markets down create the wave-like structure. Then fundamentals, real world economic factors are some of the things that make the market move. Supply and demand. When there's too much demand, the market will move up. When there's too much supply, like when the smart money are selling, there's too much supply, the market will move down. Then also inflation reports, they make the market move. Interest rate changes, they make the market move. And also GDP data affect the confidence required to transition between phases. All these things here, I'm going to teach them here on my YouTube channel, and that's why you need to subscribe to the channel. You need also to like always as you watch the video, and also remember to comment and share so that you help in growing this channel to as many people as possible. All right, so now let's move. There comes the conclusion, the strategic edge. So you need now to come up with the strategic edge, how to win the cycle. Okay, so the goal for smart traders, like when you learn this information like I've taught here, you are being created or changed into a smart trader. All right, so here we are saying buy when others are fearful, during accumulation or re-entry accumulation. Like there was a point where I chanced. Let me open a different chart. I chanced the BTC when I saw, oh, BTC is in accumulation stage. Let me just show you what I marked on my chart here. Let's hope this is the one. So I've just opened a different chart and it is loading. Or did I remove everything on this or no? So I want to show you what I noticed here. Here, look what I did here. If this level is broken, it means buyers have exited their position, because I noticed that there was accumulation here, and this is after they accumulated, they began pushing the market up here. All right, so they pushed the market up here. So now I didn't participate, and here I was caught in the hype and lost here, as you can see. Here also I lost because I thought now they are beginning, yet they were just putting their positions. Now there is a trade that I made somewhere. Here I didn't do anything. I realized, oh, this is how they are moving now. They sold, and I said, oh, so they will be accumulating. So there's a trade here accumulating. Then I noted as they are coming, they might not break this level here, because this one came, it rejected. I said, oh, so these have not yet exited. So they have noted that this position is undervalued, so price is undervalued, so they are likely to buy again. So here I placed a buy. So let me just try to zoom in so that we can see where I bought here. I think, yeah, this is here. Let me try to show you this trade, if it will be able to show. This is the one I took here. So I think it was in 5 minutes. It was identified as quickly as possible in 5 minutes, and it was the one of the quickest trade that I ever took. It was quite very fast, this price action which took place here. Yeah, I think this is the one. It happened very fast. Is this the one? No, these are others that I took. Okay, which one? Not this one. Yeah, it is this one here. This one here. So it was the quickest buy here. So it happens within a very short period of time. TP was hit. Then here again there was another one that I caught here. Then here I thought it would go. Smart money began selling. They accumulated some position, hype. Then here again I got a loss. Then here I caught it. Again here I caught it. Here again I caught it. Then it went here. they began selling these guys. I lost here, I lost here, because of a signal that I saw. Then that signal misled me. Then I lost here, here I caught it. Okay, so this is where the price is now. So price is now here. All right, so now it's very important to identify these psychological levels of the market, because when you do so, it is going to help you know at which stage you are. So we are saying now buy when others are fearful during accumulation or re-entry accumulation. Sell when others are greedy during euphoria, when people are excited. When you see a sell, you need to do a sell. A sell. Of course, they say the trend is your friend. So the trend is your friend to who? Especially to us retail traders, but not to smart money traders. So yes, for us retail traders, we are supposed to capitalize on these trends here when there's a euphoria, but with caution, because during the euphoria period, price moves very fast. Price moves very fast. So when you identify it, you can participate with caution. You just take short trades, 1 to 2 risk to reward ratio, or 1 to 3 risk to reward ratio. Avoid the long trades. Like you placed a trade here, then you are just waiting for it. No. That is a very, very, very risky. That is very, very risky. You avoid that. You need just to be taking short ones. You come out. A short one, you come out. 1 to 2 risk reward ratio, so that you avoid being caught up when the smart money are selling. Just a short one are the one you are supposed to get involved in. So always analyze structural phase before placing a trade. So you analyze the structure, so that you know the phase at which you are before placing a trade. Avoid the trap of chasing the hype. Okay, so this is it which I wanted to educate you guys on my channel. So if you have enjoyed this video as much as I've enjoyed it myself, please, if you haven't yet subscribed, kindly, I'm begging, remember to subscribe. Also like the video, also comment in the comment section, so that I know that you are following. It will help me to do as more videos like this as possible, so that our YouTube channel can continue growing. Thank you so much for watching. For now, bye, and please